My friends, hello and welcome to this fundamental finance course. Today we're going to talk about leverage, the leverage effect. So let me explain from the beginning. Let's say you have a portfolio of 1,000 euros, you deposit 1,000 euros with your broker, and then you will operate with 1,000 euros. Let's say, there you go, I have 1,000 euros like that, and I operate with that amount on the market. Let's say I buy stocks. There you go. I buy stocks and I'm good at it. Okay, so I buy stocks. So I buy 1,000 euros worth of stocks. Then what will happen is that let's say I make 10% more after a year, I make 10% more on it. So now I'll end up with 1,100 euros, you see. So I've made 100 euros, you see. That's good. But if things go badly, you always have to consider the other side too. Let's say I lose 10% at that point, I end up with 900 euros. So that's fine. That's all good. But the problem is, let's imagine that I'm thinking about making 100 euros. I managed to plan for 10%. It's still huge in the market to manage to achieve a 10% performance. Even when the market moves against you, you still make 10%. Honestly, you're skilled, except that since you don't have a lot of funds, you only make 100 euros. In absolute terms, then it's true, 10% is good, but in absolute terms, you only made 100 euros. You see what I mean? So there's a system called leverage. So leverage. In practice, some brokers give it to you automatically when you open the account, but more often you have to ask for it, you have to activate it. What does all that mean? It means that they lend you money. They lend you money based on what you've deposited. They lend you multiples of what you've deposited. So it's not money that you can take out and walk away with, but you can use it to trade. I'm just telling you this for now, just to explain. And to simplify the equation, we have a leverage of 10. Let's say, well, there you go. We have a leverage of 10-10 because there's a very high leverage. Personally, I've traded with a maximum leverage of 5. I've never gone beyond 5. I think that people who go beyond 5 are kamikazes. Even at 5, you can get hurt. But let me tell you what the idea is. The idea is this. The idea is that if you have a leverage of 10, you've deposited 1,000 euros. That means your ability to operate in the market now, with the help of 10,000 euros, now you can operate up to 10,000 euros. Out of the 10,000, remember, 1,000 is yours and 9,000 is what was lent to you. And it's not a loan based on a file, on collateral, or with interest. No, just right away you click. Well, there you go. You have a spending capacity of 9,000 of 10,000 euros. There you go. We've multiplied your money just like that. But they risk nothing. The house risks nothing. Remember, the broker is a bit like the house, like the casino. The casino, whether you lose or win, do they always win? Every night when they close, they do the accounts, they've made money, no matter if most of their clients came in and they've dropped money on the blackjack tables and others and left without it. That's not the problem. They always win. They win based on volume. Okay, a casino, 500 clients per night, they don't make as much as a casino where there are 5,000 clients per night. So what they want is the maximum number of people coming in and betting a lot. It's pretty much the same thing with brokers. That's why they lend you money for free. Let me explain. Look in here. We'll break it down. There's 1,000 plus 9,000. So we're going to have 1,000 plus 9,000. So the 1,000 is yours. That's your own money. The 9,000 is what we've added as intervention capacity to give you a complete portfolio of 10,000. Now, here's how it works. Let's go over the same calculation. If you win, let's say you make more than 10% at that point, you earn 1,000 euros. So you see, you multiplied by 10. Did you see that with the same thinking, the same work, everything equal, the same focus, the same skill? You just multiplied your income by 10. That's pretty amazing, isn't it? So now you see, in case of a loss, what happens? You always have to think about the loss, okay? So in case of a loss, let's say the market moves against you and the market drops by 10% now. What will happen? You will also lose 1,000 euros. You will lose 1,000 euros. So at that moment, what will happen? The 1,000 euros you lost, it's not the 1,000 euros, it's not the 9,000 that were lent to you. The 1,000 euros you lost, it was 1,000 euros of your own. So At that moment, what will happen? When you reach that and you get to minus 1,000 euros, let's say you bought some stocks. Okay, let's say with those 10,000 euros, you went and bought stocks because you thought it was going to go up, that it was a company with vision that knew what it was doing. You had read some news, all that, and you told yourself, this is it. I'm sure this is a good move. You bought 10,000 euros worth of stocks. So what will happen is that if things go wrong and it drops by 10%, now the total value of your portfolio is 9,000. Now you're down to the broker's 9,000. And the broker, I guarantee you, he will never allow his own money to be lost. You lose your money, that's fine. But their money, you won't lose it. So what's going to happen then? They've lost 1,000. Okay, so you're starting to touch their money. You're going to receive an email, a text message. It could even go as far as a phone call. So what happens is they'll send you a message saying, cover your margins. They do what's called a margin call. This word, you really need to know it, margin call. Typically, you get emails, texts, all that, margin call, margin call. What does it mean? Basically, it means they're telling you your money, your 1,000 euros is lost, it's over, we won't let you go into our money. To us, so what we want, that's why we lend it to you without asking for collateral or anything else. They tell you to add more money or make a transfer. When you get a margin call and want to keep your positions, you typically make a transfer. So you send money at that point, you get back into the positive, your portfolio is now above 9,000 euros, they're fine. It's your money that's still at risk. Otherwise, what happens? Let's say you don't have any more money or you ignore what they're doing. When they see that you're getting close to their money, they're going to trigger the sale of your shares. They're going to sell them. Then at that point, when you come back, you find that your shares have been sold on the market. So they dump them on the market, they sold them automatically. The fact that you're using leverage means you're allowing them to sell your shares to cover the margins if necessary. And at that point, when you come back, you'll find that your portfolio. Now, the money you have left, maybe you only have 25 euros left in your account. And then the shares you had were sold at a loss. You see, that's a margin call situation. You have to be very careful with that. When you use leverage, you speed things up. So I'd just like to tell you one thing. And why were people ruined last October and all that? Why were people ruined on cryptocurrencies? Why did some people suddenly find themselves with nothing overnight? You know, in Dubai, there are cars that have been abandoned. There are people who left behind cars worth six figures, cars worth 200,000, 300,000 euro sports cars. They arrived at the airport, parked their cars, had a suitcase, walked discreetly toward the economy check-in counter, got their boarding pass, took a plane, and disappeared. All right, because they were broke, they were wiped out. Some millionaires had to call their parents to buy them a plane ticket because their cards were blocked. You see, that's how extreme it was. Imagine your son calling you collect at 3 a.m., asking you to buy a ticket right away. You see what I mean? That was the situation. Why? Because they were leveraged without. So leverage without, it's huge. So leverage without, you put in 1,000 euros, you have the ability to act with 100,000 euros. You see, it's huge. So there, by putting in 100,000 euros, if the market moves 10% in your favor, you just made 10,000 euros while your own funds are only 1,000 euros. So you multiplied your own funds by 10. It actually multiplies that percentage. But on the other hand, it only takes the market to go 1% in the wrong direction. You're wiped out immediately. Your equity is wiped out. You get a margin call. If you don't react, there's a sale. Okay, a forced sale. Where does the money come from? The money, where does the broker get it? Why do you lend money? 9,000 euros, where does it come from? All right, that money, the leverage, because it's a real loan, where does it come from? It's not virtual money, it's real money. Actually, it comes from investment banks. Why? Because the broker does this, the broker goes to the investment bank and he tells them, look, I have my own clients who, with their own money, have deposited, for example, 100 million into the account. All right, in my accounts, I have 100 million, that's clean money. Lend me money so I can lend to them, so I can give leverage to some of them. So what they're going to do is tell him, okay, we're going to add 400 million for you, We're going to trust you. Since you have 100 million, we'll lend you 400 million. Knowing that your purely software-based system does not permit losses, that means the investment bank is lending this money knowing that it will be used like cheese for mice. When the mouse arrives, snap the trap. It will never eat the cheese. It will die before. They say, we'll give you money so you can show up and put it in front of people. People will want to invest. They'll get their money eaten up by the market because that money now, you see, that money has been taken. It's over. It doesn't exist anymore. You're wiped out. You've paid fees. So they make their living. There are several ways they make their living. One way is through fees, trading fees. You sell, you buy. Every time people, there are fees, there are custody fees too that they take. There are also fees, not just fees. It's more like money they can borrow using the money you deposit, because the money you deposit serves as collateral for them to borrow even more money. You see, so you increase their financial standing, you improve their financial situation, and that money you lost, it might go to another client of theirs who won, so it stays in their system and allows them to borrow more. There are other methods, some of which are borderline illegal or completely illegal. That's when, for example, internal arbitrage happens. Internal arbitrage is, I have a client. He tells me, no, I'm a broker. I have a client. He wants to sell. He wants to sell. For example, a Bitcoin, he wants to sell it. He wants to sell it and someone else wants to buy it on my platform. What should I do? I take it, I'm there, I put it, I'm there. You see, since I'm not buying or selling, there's a spread, a difference between the buying and selling prices. Well, I take the difference along the way. So I'm just doing arbitrage. You see, I'm just doing arbitrage. I don't even need to go to the market, and I can do it with stocks, with anything, you see, just by arbitraging between clients inside the platform. But there are still, that's still legal, but there are still situations where it can become purely illegal. That's when the platform plays against its clients. For example, I have a colleague from the United Kingdom who lost 4,000 euros on a platform right in front of me. Why? Because it was a platform with contracts for difference. So basically, these are platforms where you're betting on the direction the asset will go, so the stock. So there was a stock. He was sure it was going to go up. So he put money in. You see, he put in 4,000 euros. Then there was leverage, huge, enormous leverage, though I don't remember the exact amount. Then the stock moved in the right direction. For him, you see, it went up. So at some point, what does he want to do? He wants to sell because suddenly he had 4,000 euros invested, multiplied by the leverage, then by the percentage increase. Here, I don't remember exactly how much he had, but I think he had 20,000 euros, something like that, you see, in profit that he wanted to take. So he wanted to take 20,000 euros in profit. He clicks to sell and it doesn't work. What does the interface do? It freezes, it locks up, then it says, we can't execute your order right now, and it starts acting up like that. And that's platforms that are, it's cheating. These are platforms designed to block, to lock the client when they're in a winning situation. Why? Because the platform is playing against the client. Because in reality, when the client has placed an order, okay, the platform hasn't collateralized it. Behind the scenes, the platform failed to protect itself. He placed an order, but they did nothing. If things go well and he needs 20,000 euros, they'll have to pay from their own pocket. You see, because they didn't do anything, they didn't go buy the stock or buy options on the stock. If you ask them, they did nothing at all. So their system is programmed so that when the guy clicks on sell, you see, to get out, it locks him in. He can't get out, so he stays like that. He starts yelling. Anyway, I went over to him like, what's going on? I knew he spent the whole day on this at the office with little to do. He kept clicking, but it didn't work. He said it was locked, so I tried to help, but it still wouldn't work. And what's going to happen? It's going to stay locked for a good half hour, and when it finally goes through, it drops, okay? And then he's in the negative. At that moment, we can execute it in order. You see, at that point, the order goes through, it works. You see what I mean? You have to be very, very, very careful. And that's why, even though I'm not sponsored by a broker in these videos, so I don't care which broker, where you go, with one or another, that's not my problem. I'm not trying to sell you any particular broker. But be very careful. Go with reputable people, because if you go with shady ones, there's no chance you'll win, and you'll never win. You'll just end up, there will always be technical issues, blockages, and your funds may get blocked. These are just some of the problems. People who put in money, who win, and when they want to withdraw it, that's when they start giving them a hard time. Yes, we saw a coin of your residence, I don't know, proof of address, and they don't bother them about that. When they deposit money, they take it, but when they want to withdraw it, that's when they do a ham, egg, cheese type. Know your customer, know your customer, know your customer. The banks do it. Know your customer, know your customer. You see, and they do ham, egg, cheese, okay? And they give them a hard time and they'll never see the funds. Okay, so be very careful about that. There you go, my friends. That was leverage. So leverage is interesting. It's one tool among many others. And here, in this finance course, there is no particular incentive to use leverage. But if I can give you some advice, it's that if you're starting out with the stock market, don't touch leverage, stick with your own funds. Okay, don't touch it. Once you gain experience and feel more comfortable, you can occasionally use a little leverage on small trades, you understand, then return to your usual approach. All right, just quickly, but don't overthink it. Okay, thanks for staying until now, and I'll see you in the next video.